Welcome all to the NCEO 2020 virtual webinar, Capital Planning Through the Life Cycle of an ESOP Company, with your guests Steve Ryan, Greg Hogan, and Guillermo Dora. My name is Steve Ryan. I'm a director of Prairie Capital Advisors. We're a business ownership transition firm. We have full investment banking capabilities with the ESOP experience. We do over 350 valuations per year. Prior to that, I had 25 years worth of banking experience, including managing teams at the Northern Trust Middle Market Client Group. Greg?
Good afternoon, all. My name is Greg Hogan. I'm a managing director at SC&H Capital. We are a boutique investment bank based outside of Baltimore, Maryland, and I run our ESOP advisory practice and also provide sell-side advisory services to lower middle market business owners.
Good afternoon. My name is Guillermo Doria. I am the ESOP practice leader at Bank United. Bank United is a $34 billion asset-sized bank located in Miami Lakes, Florida. Our two primary geographies are the state of Florida and the New York metropolitan market, but our national lending practices and our specialty verticals, including ESOP, has a much broader reach and has national clients.
And as you can see on slide 3, it really kind of talks about the life cycle of an ESOP. And this really explains kind of the purpose of our presentation today. And I'm going to walk you through effectively the transaction pre-cycle throughout the life cycle. On the left axis, you have the financial flexibility that a company has. So in a pre-transaction basis, you have a company that tends to have less financial leverage on itself and high flexibility. Over the course of time, you go from left to right. The post-transaction, you'll see in the leveraged ESOP formation where the financial flexibility goes down substantially, and then over the course of time, as the company uses excess cash flow from operations and the tax advantages of not paying any taxes to be able to deleverage the position of the company. So it goes from the leveraged ESOP to leveraging out, paying off the outside leverage, which effectively would be the bank debt that we'll get into in a minute. You got the internal deleveraging, which as we're defining that, it's really more of the seller notes versus the internal note. And then you go into more of a mature ESOP situation where most of the leverage is completely paid off, and then their company is looking at its repurchase obligations. If you go to the next slide, what we also have is a summary of a transaction of a company that was originally going to present for the ESOP when we were live. This is an example of a company that actually had gone through an ESOP transaction that had some challenges. So the company was founded in the 70s. It was done for the purpose of succession planning, rewarding its employees, diversification, and recruiting, all purposes that are typical for companies that are doing an ESOP transaction. The business in and of itself is a material handling consulting business with target markets, multi-locations across the U.S., various different industries, including some stable industries like food and beverage, a little more cyclical businesses like automotive. And effectively in and of itself, it was a business service in addition to the facilities it provided. It also provided construction management, project management, logistics, a lot of other different services that companies need as they're taking care of their logistics and storage needs. And then with that, I want to try to transition this to Greg to better define what we're talking about from a capital allocation perspective.
Yeah, thanks, Steve. My name's Greg Hogan at SC&H, and we're going to spend the bulk of the presentation here today talking about capital allocation during the life cycle of an ESOP company. And as Steve just mentioned, the financial flexibility of an ESOP really changes very substantially during the course of a complete transaction cycle for an ESOP company. And so what we're going to focus on today is really looking at the 5 kind of options for capital allocation that you see here laid out on this page, and really talk about how the company and the management of the company should use the cash generated by the business in order to maximize shareholder returns or maximize that IRR. And as we all know, there's a lot of different competing options in terms of uses for cash. but generally we look at them in kind of these 5 different buckets for an ESOP company, or a non-ESOP company for that matter. The first one is really organic growth, and that is, reinvesting the cash flow of the company back into the business to fuel for future growth of the company. And that can take a number of different forms. That can be, capital expenditures, buying equipment or opening new facilities. That can be spending money on R&D, product development, sales and marketing, corporate infrastructure, hiring people. All of those are ways of reinvesting dollars back into the business to drive organic growth. And all of those, by their nature, tend to have more long-term returns to shareholders. The other option, the second one listed there, is really inorganic growth, and that is by way of acquisition. So the company can use its cash flow and debt capacity to go out and acquire businesses. If there's an opportunity there that seems to make more sense than trying to fund that growth internally. So certainly that's really the inorganic option of using cash flow generated by the business to drive future earnings and cash flow growth. And then further down the list here, the last 3 are really returns of capital in one form or another back to the shareholders. So certainly you can pay out dividends of excess cash flow from the business, which is very, very common in publicly held companies, probably less so in many ESOP companies for reasons that we'll discuss later, but certainly that's one way of providing return to shareholders. Very common in ESOP companies is using cash flow initially, at least, to repay debt. Obviously, that's very applicable for 100% leveraged ESOP transactions that require cash flow of the company to be used for a period of time post-transaction to repay debt. And that's a very predictable source of return to the shareholders in the form of saving of the interest expense, but not necessarily always the highest return to shareholders or the best use of cash in terms of driving IRR. And then finally, you can use that cash to repurchase shares. Again, very common in the public company world, but also common in the ESOP world in a number of different situations. And so what we're really going to talk about today is the importance of management really understanding these 5 options and understanding how allocations of the company's capital can provide the highest return to shareholders. And it's not always possible to definitively know the answer to those questions up front, but definitely should be something that management is thinking about in the day-to-day operations of the company. And so as we go through this, we'll talk a little bit about those various uses of capital, but we wanted to start with spending a little time talking about kind of common capital structures for ESOP companies. And, it's important to understand kind of market-based capital structures because decisions about capital allocation by a management team always must be made in a fashion that keeps the company in alignment with a market-based capital structure in what is reality. I think the most common example we see of those two in conflict in the lower middle market is businesses that we come across that may want to make an acquisition, but oftentimes in reality, when they get into understanding valuation and capital structure, sometimes they can't afford to make that acquisition because they don't have the debt capacity or they don't have the excess equity to fund that acquisition. And so these decisions always have to be made in the context of what's possible from a capital structure standpoint. So you see there on the left-hand side of this slide, both kind of the typical private equity capital structure, and then on the right-hand side, the typical ESOP structure, both of which start with a senior debt component that is essentially the lowest risk and also lowest cost of capital form of financing a business or an acquisition for that matter. And Guillermo here in a second will spend some more time talking about what that senior debt capacity for businesses looks like in the market today. But that usually is the first form of capital that companies go out and try and place. And then in an ESOP structure below that senior debt capacity, the balance of the capital structure in 100% ESOP-owned companies is normally filled, at least initially, by seller subordinated notes. And so, you know, we have on the right-hand side in an ESOP transaction, basically 100% debt, with one portion being filled by the senior lender and the balance being completed with the sellers. A little bit different on the private equity side because you actually do have equity in that capital structure there on the bottom left-hand side. But over time, obviously, that equity is what you're trying to create by deleveraging the balance sheet in an ESOP context. And so now I'll turn it over to Guillermo to talk a little bit about current conditions on the senior debt market side.
Thanks, Greg. So, you know, full disclosure, this slide was prepared about a month ago before we entered into the environment that we're currently in. So as you all may well know, the course of our economic cycle changed in a very few short weeks. So we went from an environment where capital markets were thriving to an environment where capital markets were frozen for about a week as banks awaited guidance from the Fed on corrective measures. And what resulted was the SBA Paycheck Protection Program that you have all probably been hearing a lot about. So just wanted to give you a quick summary on what that program looks like and also speak about the Main Street lending program, which was just announced late last week. So in terms of the SBA Paycheck Protection Program, it's a $350 billion program that is really tailored for small businesses. So businesses with up to 500 employees. Loan sizes within that program capped at about $10 million. And the program is designed to provide direct incentive for small businesses to keep their employees on the payroll. And how does the federal government do this? Well, the Fed will effectively forgive these loans if the funds provided are utilized to fund payroll costs, interest on mortgages, rent, and utilities. Furthermore, interest and principal on these loans are deferred for the next 6 months. No collateral is required, no personal guarantees are required, and neither the government nor lenders can charge small businesses any sort of fees associated to getting these loans. So, you know, you think about businesses with up to 500 employees, that captures a small portion of sort of our overall middle market. So late last week, the Fed announced the Main Street lending program, which is going to be more geared toward mid-sized businesses. So businesses with up to 10,000 employees or companies with revenues less than $2.5 billion. And that program is going to be bifurcated into two distinct categories. The Main Street New Loan Facility program is going to be applicable to new loans to eligible borrowers. And the max on the new facility program is going to be $25 million, or an amount which does not exceed 4 times fiscal year end 2019 EBITDA when consolidating all pre-existing debt. For larger businesses with existing credit facilities, the Main Street Expanded Loan Facility program is going to be available to borrowers that have pre-existing debt. And the cap on loan size in that program is going to be the lesser of $150 million, 30% of your existing but undrawn debt, or an amount that, when consolidating all of your existing loan commitments, does not exceed 4 times EBITDA. So this is the Fed's way to really prop up the economy in a very uncertain market environment. The maximum for either of those two options on the Main Street lending program side, in terms of tenure, is 4 years. Principal and interest on those facilities can be deferred for a year, but unlike the Paycheck Protection Program, these loans will not be forgivable. And eligible banks may originate these Main Street loans, but unlike the SBA program, banks are going to be required to hold 5% of the commitment amount, while the federal government purchases the additional 95%, and the total universe of funds available under these programs are $600 billion. Again, at its core, the purpose of these loans are to make a reasonable effort to maintain payroll and keep folks employed. Specifically as it pertains to the ESOP lending space, I believe that environment's changed quite a bit in the last few weeks as well. From what I've seen, banks are becoming a lot more selective on new money opportunities, and they're seeking full relationships more so than they had in the past, meaning in addition to looking at things like cash flow and collateral, banks are also considering things like how depository rich is this opportunity. So it's great to be able to put $15 million of financing on the street, but if it doesn't afford you a depository opportunity that's fairly sizable, it's a harder pill to swallow in an environment where banks are looking to maintain liquidity.
Jeremy, thank you for the update on that. We appreciate that. It's amazing how the markets have fully changed, and the hope over the course of time for this presentation that we're doing is really that we fully expect at some point we will get back to normal. And the goal of getting back to normal is that eventually opportunities for people to continue to manage their business goes forward. So our slide, what's the next slide?
Slide 9 is also mine. We're talking about senior debt capacity and how a bank assesses the viability of a ESOP transaction, or really any sort of amortizing debt type of transaction. So when we're looking at ESOP lending, there are two primary drivers in our underwriting. So number one, cash flow. We always look at that as our primary source of repayment. And secondarily, we look at assets or other credit enhancing mechanisms such as guarantees to help us assess the viability of an opportunity. So ESOPs are unique in that loans in the ESOP space, especially for 100% ESOP conversions, may not potentially enjoy full tangible collateral support, meaning that the loans are often undersecured. So an example of such a transaction is illustrated here. So you effectively, utilizing a 3-time valuation multiple on your ability to provide senior financing at 3 times, you arrive at a $45 million facility. You compare that to a collateral base, which really shows $25 million in tangible collateral. You find yourself with a $20 million undersecured position, which is often referred to as an airball. So when you have these types of facilities, banks really hone in on the quality of cash flow. And what do I mean by that? We look at how stable and how predictable EBITDA and historical cash flow has been to help us assess how much debt we may be able to provide in any one transaction. This is simply an illustration of what I was just describing, which is your debt capacity based on a 3 times multiple is far less than your collateral coverage. So in scenarios where an airball does exist, usually banks want to see that airball completely deplete itself, most times in a 24 to 36 month window. So you'll achieve that through regular amortization, and oftentimes banks will also look to implement excess cash flow recapture mechanisms to shorten that time span. I think something also to consider is that strong asset coverage or other credit enhancements, such as a guarantee or a pledge of cash, can also help bridge uncertain cash flows. So if there has been some lumpiness in historical performance, a strong collateral base can help ease a lot of the concerns that a credit officer may have at a banking institution. So what is the impact that an ESOP may have on cash flow coverages of a company? I think one of the things that's important to note in this particular illustration is the fact that this company converted to an S corporation ESOP as a result of this transaction. And as you'll see here, the tax benefits associated with the S Corp designation were pretty material to the point where the company is generating $4.5 million of additional dollars to help service its debt, which is quite impactful when you're looking at this from an underwriting perspective at the bank. One of the things that we also look at is how much cushion does company's historical cash flow have relative to the amount of debt that we're providing. So in scenarios such as what we're dealing with now with COVID-19, or under a scenario where you may have a client that walks and it's a pretty sizable client, you know, we want a company to demonstrate an ability to service our debt and continue to perform under a duress scenario such as the one I just described. So we're always going to sensitize cash flows to a certain degree to understand how much cushion there is under the what-if scenarios. Just as a general point here, covenants under this market environment, you can expect to tighten a little bit. You're seeing the two main covenants utilized in ESOP transactions were fixed charge coverage ratio and cash flow leverage ratios. You can expect a tightening of that, meaning whereas if you'd been seeing fixed charge coverage ratios at around 115, you're probably going to see things at closer to 125 or 130 until things start to level off and stabilize a bit. And leverage ratios from a covenant perspective are also going to be much more conservative in nature.
And it'll still be determined kind of how in this COVID-19 environment, how the banks are going to be looking at many of those covenants. I mean, some of them, I've heard some of the credit people are going to say, is this a one-time event? And each institution is going to look at that somewhat unique from what I'm hearing. Is that correct, Carol? Is that what you're hearing?
Absolutely. We're going to, you know, look at transactions on a one-off basis. You know, I've seen some companies recently that have been impacted very materially and continue to perform. So, you know, we're certainly going to structure covenants, you know, based on what we're seeing on a deal-by-deal basis.
Okay. So as we go to slide 12, we'll kind of slip back into kind of a normal operating environment outside of the COVID-19, and we know that has changed everything for everybody. But eventually, we will get through this, and things will get back to normal. So, if you look at this slide here, it typically highlights a typical deleveraging chart for a properly structured ESOP. So, as we pointed out, the transaction closed at over 6 times. Guillermo had talked about having 3 times senior leverage, the rest of it being filled by seller notes. And as you can see, kind of post-transaction, the far left, the upper, it's 6x. Then as you're going down through years 3, 4, and 5, the company is taking advantage of the tax benefits to be able to deleverage quickly. And then, you know, based upon the kind of cash flow projections, again, these are normalized projections. We understand there's always lumpiness in projections, but we try to do it as normalized as possible, that come year 6, the company has fully paid off all of its senior leverage, and then all of a sudden it's looking at other forms of leverage as you move forward. Go to the next slide, number 13. So on 13, this really kind of highlights kind of the sources and uses of capital through the capital planning. So on the left side, you kind of got the internal sources that you can use, and effectively, I mean, in the top base, you really should have cash up there as well. So effectively, you've got all the cash flow from operations that's kind of embedded within the upper left-hand side, where you've got the inside debt, retained earnings, which retained earnings would be cash flow coming from the profits, sale of some potential stock, fixed assets, and some other debt collections, which would be other obligations that may be owed to a company. And then you have the external sources, which would be any forms of lending that's coming through the banks, other forms of capital, whether it be private placements, senior subordinated loans, or some other obligations that are coming in from families or other sources of capital. That's all capital that's coming in to a company. And when you look at the right side of it, is where the capital allocation going. And Greg had talked about these various forms of uses of liquidity uses of capital as it pertains to it. So the middle items, though, will dictate and drive kind of the uses on the right-hand side. And that's really unique to each company. So the company's profile, what industry is it in? How capitalized is it? What's the nature of its cash flow stream? What are what stage is the business in the industry? It may be in a high growth industry, and if it's a high growth business or a high growth industry, there's going to be more capital chewed up by use of working capital. So each company is a little bit unique. In addition, the strategic objectives. Each objective for each business and that's usually driven by the board and management is going to be somewhat unique based upon the kind of nature of the business and what are the things they want to accomplish. The risk appetite. Some managers and businesses are very risk adverse. How are they going to how they've managed their business for extended periods of time probably isn't going to change both from a pre-transaction to a post-transaction, other than knowing that if they've added a lot of leverage, they're going to probably be more conservative on how they do the alternatives. So when they're looking at the things on the right-hand side as far as investments, they're going to look at that and say, boy, am I going to be more likely to do organic growth versus mergers and acquisitions? And organic growth is a less risky investment than an M&A type of transaction. So effectively, in all these things, when you're looking at these investment opportunities and the return analysis needs to be done, is saying, based upon our business, based upon the drivers of our business, how are we going to be able to use the sources of capital that are coming from the left side to maximize the use on the right? Initial stages, the companies are going to really use most of their excess cash flow to deleverage. But over the course of time, as they're balancing that leverage portion down, then they're having, what other obligations are we going to be able to put this capital at risk for? The net impact is the choices in either case is either increase or decrease the value, right? So as you're making the choices of allocating the cash flow and the capital that's being sourced and investing it on the other side, either the goal is to obviously increase value, but sometimes you make investments that don't have that return, so you got to be careful in understanding the balance and how that reacts for each company. The next, the key is for management and the board to kind of understand the intersections between the life cycle of a company and the life cycle of its ESOP. Because when you first initiate an ESOP, that especially when we're doing 100% assumption of 100% leverage ESOP, most of your focus should really be going towards debt reduction to try to reduce the risk structure of the business as much as you can. Now, each business driver or each management team and board understands the business drivers of these businesses. So the focus is on planning and projections to be able to identify as best you can what the business is going to be doing going forward, to be able to then adjust the ESOP structure based upon where you're at in the structure. You can take more risk if you're in a positive planning or a positive operating environment to take more risks for the business to be able to grow. You also need to really understand the obligations of the plan and overlay those obligations with the business plan expectations. So as you're looking out and you're, say, years 3, 4, and 5, and you're migrating from being a deleveraging environment to more looking at investments in other opportunities or repurchase obligations that may come out in the outer years, or you may have warrants coming due, those are the things you need to plan for as part of that capital allocation. And it should also, this whole discussion really should also be part of any kind of board conversation. So the board should really have this capital planning as part of their ongoing board dialogue when they're having conversations about what's going on with the business, how does that business represent to what's going on within the ESOP plan. Now, Greg will walk you through a little bit of the kind of the deleveraging years.
Yeah, thanks, Steve. So, as you mentioned, the deleveraging years that immediately follow a leveraged ESOP transaction, we found are oftentimes some of the most stressful for a management team because, as Steve talked about, that leverage ratio or that amount of leverage that's on a company's balance sheet often far exceeds what any of those management folks have ever had on their balance sheet in terms of debt. And so he's absolutely right that in the initial transaction years, reflecting back on those capital allocation choices, oftentimes that choice in early years really isn't much of a choice at all. The company's using a lot of their cash flow to service debt, either because they want to de-risk the balance sheet and they're not comfortable running a company with that high of leverage, or even more often, the covenants and excess cash flow recapture features of the senior loan facility that Guillermo was talking about earlier really require the company and the management team to push a lot of that excess cash flow into deleveraging the balance sheet more quickly. So in those early years, certainly kind of years 1, 2, and 3, oftentimes that's the primary focus. However, I do think there's also a balancing act that does occur in a lot of the companies between obviously using a lot of that cash flow to repay debt, but also making sure that they find a way to either generate or preserve enough of that cash flow to really focus on organic growth and executing the company's mission to grow the business. And oftentimes that growth requires a use of capital. It could be really in any of the forms that we were talking about earlier: people, assets, sales and marketing, working capital. All of those things are a use of cash. And so there needs to be an important balancing act that happens in these initial years between making sure that you're meeting all of your debt covenants, but also making sure that you're not doing that in a fashion that starves the company of cash flow that it really needs in order to sustain growth and take advantage of opportunities in the market. And so oftentimes we find ourselves, and our clients find themselves looking at, how do we improve the cash flow of the business? What are some of the things that we can really do to create additional cash flow so I have a little bit more cash to use for some of those organic growth opportunities in these initial years? And so we see them exploring, how do we grow the business? How do we expand our profit margins? What are some of the things we can do on the working capital side in order to speed up that cash conversion cycle and improve our cash flow position off of that profit? How do I maximize my fixed asset efficiency? So, how do I make sure that I'm making the best use of my PP&E and not spending unnecessarily on CapEx? And then, of course, we've got the nice thing about the ESOP transaction is, as Guillermo mentioned, that tax shield is really impactful for many of our clients in terms of increasing the after-tax cash flow that's available to repay debt. So a lot of that goes to debt deleveraging, but sometimes that can also be helpful in the company finding some opportunities to spend cash on organic growth opportunities. And so, I think one of the things that Steve mentioned in that great chart on page 12 that he was walking through was, that's kind of a normal course deleveraging process where you see the business's debt leverage step down over time as they use cash flow to repay either senior lenders or seller notes. But things don't always work in that linear of a fashion, right? And so companies and management teams really need to run some what-if analysis and take a hard look at, what happens to their leverage ratios, what happens to their cash flows in the event that the company's performance experiences some hiccups, because over a 7 to 10 year kind of full deleveraging, it's very likely that many companies will experience a hiccup. And so doing some of that what-if sensitivity analysis is really important to getting the company and the lenders comfortable with a certain leverage ratio for the business.
And that's one thing that's interesting as it pertains to that too, is a lot of companies that are entering into transactions have never really operated with much financial leverage. And as these management teams are managing their business, it's very different when you're managing a business with no financial leverage that goes to 100% financial leverage.
Absolutely. And so at some point after those initial deleveraging years, and obviously it depends on kind of how well the company performs, but generally, 3 to 4 years kind of post-transaction, a lot of the senior debt has been repaid. And the company really begins to transition into what we've called here the option years, which is, years 3, 4, 5, 6 after a ESOP transaction, when the original senior debt has been repaid, and oftentimes the company has begun to amortize and pay down the seller notes that were originally subordinated transactions or subordinated debt. And that's when really the options begin to open up fairly substantially in terms of the management team's ability to use that cash flow created by the business in a number of different ways. Oftentimes the seller note structures and covenants and things of that nature are much more flexible than what you would get from a senior lender. And so there's no longer this requirement for the business to usually use as much of the cash flow to fund debt repayment. And so it really opens up really that full specter of all 5 options for management to consider. And certainly one of those options is to continue to repay debt and to continue to really plow a lot of that cash flow back into deleveraging, and that can take one of 2 forms. We certainly see some clients just begin to amortize their seller notes on normal course after senior debt has been repaid. We also see a lot of our clients essentially go back to the well and re-up with the senior lender, take out another senior debt facility and use those proceeds to prepay a portion or all of the seller notes, depending on the remaining leverage at the time that they choose to do that. And so all of those come with, interesting decisions. Oftentimes, senior debt is significantly less expensive than the seller notes, so companies can be saving on interest expense by that refinance. Senior debt today can be in that 4% range. Often we see seller notes with 6, 8, even 10% kind of all-in interest rates in terms of cash and payment in kind interest. So there's a significant delta there between the expense of carrying senior debt and seller debt that could be saved in the event of a refinance. However, that doesn't necessarily mean that that's what the company should do with the cash flow. As we mentioned before, there are other options, and it may turn out that the company is better off using that cash flow to go out and make an acquisition, because the return on that acquisition would be well north of whatever the savings would be in interest rates between the seller note and the senior note. And so management really needs to, in these option years, to think long and hard about really what are the returns to shareholders off of all of these different choices, inclusive of continuing to deleverage or looking at other ways to really grow the cash flow of the business going forward.
Guillermo, why don't you go ahead and talk about the what ifs in the next slide?
Absolutely. Thanks, Steve. So as Greg mentioned, it's in the best interest of the company to, look at and plan for the unexpected events. We're going through an unexpected period of time as we speak. So, I think that the underlying message that I wanted to convey in this slide was communication is key. Communication with your trustees, communication with your bankers, with the ESOP team, with your board, to make people aware of the situation so that preemptive measures can be put in place. It's much easier for a banker to react to something that he or she sees coming down the pike for a few months than going to a credit partner with an issue that needs to be resolved within a week's time. So as can be seen in this illustration, this transaction was closed at close to a 3 times senior leverage multiple, 5.6 times total debt multiple at close. Obviously, they hit an issue in 2014, and the total leverage multiple increased from 5.6 to 9.6 times. So when that occurs, again, I think communication is key. Most banks are flexible and willing to work with borrowers so long as folks are acting in good faith. But certainly strategizing sort of event needs to occur, and a plan needs to be put together and talked about as to how material issues in company's operations are going to be handled moving forward.
And just for people's reference, this is a continuation of the case study that we had talked about in slide 3 about the business. And the business ultimately, one of their clients, they lost one of their clients, represented more than 30% of their revenue, which then all of a sudden revenue fell off in 2014, placing additional pressure on the company's cash flow. An interesting thing that you can see here, at least in the chart, is yes, total leverage is significantly higher, but the seller note in and of itself is financing most of that burden. So the senior leverage and the bankers tend to be more willing to work with something. It's a scenario like that. Next page.
That's right, Steve. Yeah, and under that sort of scenario, what banks or bankers will often do is suppress the interest payable to that seller note and take it for the foreseeable future if there are cash flow issues. And if there are not, things will continue to operate at par. But certainly discussions have to be had around what the performance of the company are potentially going to look like in the short and long run. The following slide is just illustration of the slide before. So you're seeing that linear sort of deleveraging at the bottom of the page here, and then what actually occurred. So I think the underlying message is here, you have to prepare for the unexpected.
And on the next slide, we really call this the teeter-totter slide, because the focus is on the plan versus the business, and the business kind of in normal operating environment. Let's assume that the what-ifs haven't occurred. You're planning for them, but yet in this scenario, so your focus really is visually. It highlights through the life cycle of an ESOP. So as you can see, the free cash flow is in the green. As we had talked about sources of capital, which we're defining at least in this point as free cash flow. On the right-hand side of each of the teeter-totters, you're showing in the kind of post-leverage scenario when you initially do the transaction, a significant portion of that debt service, which would be really principal and interest, is going to repay that obligation. And you're assuming here in each of these cases, your cash flow is relatively kind of stable. I mean, in the perfect world, your reinvestments that are in the yellow, that are on the smaller on A, are going to ultimately grow the free cash flow side. So then as you move along, you're rebalancing out. So as you're paying down debt and debt service is becoming a smaller and smaller portion of the business that you're having to deal with, then you're having less in debt service and more in other investments in other options. And that other options, could also be repaying down the seller notes. And then as you get further down the line into the outer years, when you're starting to look at the repurchase obligation, then becomes more material. And when you're talking about this, you're talking about years 6, 7, 8, 9. As you're getting out there, you're looking at repurchase obligation. And the key is to try to continue to maintain that balance. So as you see in this case, you're really seeing free cash flow because the other investments are starting to pay off in this mature ESOP. Then they're having to find out, well, where else are we going to really kind of put money to work? Whether it be debt service, well, debt service becomes substantially less if you pay it all off. Your repurchase obligations are really managed in the earlier portion of the years, but you have to keep your eye on it. The other is the investments, and then the goal is to put those investments out there to continue to grow to grow the business and grow future cash flow. So, but if you look at D, it really highlights kind of the growth of the potential of the repurchase obligation and the need to really kind of manage that, because if your repurchase obligation can grow to the point to where all of a sudden, instead of the scale tipping to where you're having more free cash flow to meet obligations to grow in the business, part of the mid-cycle of the ESOP, all of a sudden as it gets over, the more important of focusing on that repurchase obligation gives you less opportunities to do investments in debt service. So therefore, you need to keep your eye out on what that repurchase obligation is going forward. Now, remember, each plan is unique and should be evaluated relative to the business. Again, you should really be getting advice from your advisors, your board, your trustee, your third-party administrator, your valuation firm. They all should kind of be helping manage kind of the balancing act between the two. And in many cases, when people will retain outside advisors to work on behalf of the board to be able to look at this repurchase obligation and the sustainability of it, saying, how are we doing relative to the plan? Because when you think about it, when you did the deal, ground year one, you had certain expectations of what was going to occur. The slide that we were looking at. Well, 7 years later, things have happened. Certain things may have changed in the business or what's going on, what management is looking for, some things about the industry. So based upon that, you need to continue to kind of relook at the balancing act between what the business can do and afford, and the balance of what the plan is administered to do. Next, we're talking a little bit about some of the option years. Greg talked a little bit about this, organic investment versus growth investment. In here, the one thing that I really kind of want to highlight is a lot of it in the early portion of the option years goes to refinancing. A lot of people will look at retaking out those seller notes as best they can, try to replace that with lower cost capital. In other words, the banks are the first ones typically to come in when the senior bank facilities have been paid off, coming in saying, hey, we have no more senior debt. Let's go ahead and take out some of those seller notes as it pertains to that. And there's always a decision point when you're looking at this. And are you going to take that refinancing and pay down debt, or are there other opportunities to grow the business and do those investments? And it's really a board and a management decisions to be able to make that. And then if you go on to slide 21, so slide 21 is a continuation of what we saw earlier about this, the slide deck. And now you're out in the options further out. When you're looking at years 6, 7, 8, 9, where then all of a sudden you've paid off not only the seller note, the senior note and the seller note, then you're really looking at if there were warrants putting into the transaction and the repurchase obligation, really literally getting into where you are actually a mature company. With that, we'll go back to Greg, who will highlight some of the options at this point.
Thanks, Steve. Yes, so, as Steve mentioned, following my comments earlier, once you really fully deleverage the debt inclusive of those senior and seller notes, there's usually a period of years when that is true before the repurchase obligation begins to kick in a meaningful fashion. And those are really the years when the management team has the absolute most flexibility in terms of excess cash flow and what to do with that excess cash flow. And so wanted to touch on a couple of the other capital allocation options that we haven't spent too much time on yet to date. And the first of which is acquisitions. We pretty consistently hear from our clients over the past couple of years about interest in making acquisitions once they've deleveraged the balance sheet. And, there's a couple reasons for that that are specific to ESOPs. And I think ESOPs do have some very unique advantages that they bring as a buyer to an acquisition process that many other privately owned or private equity backed or even public companies don't bring. And that is, they tend to be a much friendlier buyer for lower middle market, family founder-owned businesses that are looking for a buyer. Oftentimes, sellers of those types of companies have a very negative connotation associated with private equity. They can certainly have negative connotations associated with, very large public strategic buyers. And they oftentimes find an ESOP as a much friendlier buyer and an easier sell, quite frankly, to their management teams and their employees as a buyer of a business. It can be a smoother transition for somebody that is trying to exit. In addition, there are opportunities in properly structured transactions for ESOP buyers to provide that seller with the ability to get 1042 treatment on that sale of stock to that ESOP-owned company. And so ESOP certainly brings some tax advantages to the table as a buyer. And the other thing that I think warrants mention here is that, especially for 100% owned S Corp ESOPs, they really have a substantial advantage over tax-paying entities in terms of their after-tax cash flow and what that allows them to do from in terms of supporting acquisition financing in buyouts. Guillermo's chart earlier that he went through that showed that additional cash flow that's generated by that tax shield and how it impacts that fixed charge coverage ratio is something that absolutely comes into play in the kind of acquisition structuring financing for ESOP-owned companies. So it absolutely is a viable choice that many ESOP-owned companies choose to pursue once they get into these option years, because the returns on equity for acquisitions, if done correctly, can really be far and away the best returns that the companies can earn in terms of using their capital. Moving forward to some of the other options, I'd say distributions that we talk about here on page 23 are probably, in my experience, less common for ESOP companies. You're really looking at, again, a return of the capital back to the shareholders as opposed to how to earn a return on the capital reinvested in the business. But nonetheless, distributions do come into play sometimes, especially as it relates to companies trying to reach, mature ESOP companies trying to release some targeted employee benefit level. Oftentimes, if share allocations are not as high as they had been in prior years, companies may choose to supplement that share allocation with distributions that can be paid to the shareholders. And obviously, those distributions are a use of cash for the business that has the impact oftentimes of lowering the per share value of the shares owned by the ESOP because that cash comes off the company's balance sheet and goes into the plan itself, but nonetheless is a return of capital to the shareholders that they realize in the form of increased cash in their accounts. I think one thing to be mindful of here as it relates to distributions, especially in comparison to contributions, is that distributions are allocated relative to the number of shares in an employee's account, not relative to compensation, which is how contributions are allocated. So distributions can have the impact of favoring terminated participants that have larger share balances rather than current employees that are earning compensation. And so for that reason, we normally see companies or ESOP-owned companies using contributions a little more frequently than distributions. Moving forward to the next slide, which is contributions. I think we kind of touched on that. Again, has the same kind of impact in terms of value of the company stock in that that cash is oftentimes coming off the company's balance sheet and going into the plan, can sometimes be used to repay inside loans, which then would bring that cash back to the company. But most normally, if that contribution is being made to reach some target benefit level, that is cash that might stay in the ESOP. And again, this is probably more favorable to current participants and employees as opposed to terminated employees, because contributions are allocated on the basis of relative compensation. And then finally, we've got warrants, which oftentimes are attached to the seller financing that we were talking about earlier, but essentially are a call right that former seller note holders have on the equity value of the company at some point in the future. And those warrants, the value of those warrants is obviously dependent upon company's performance and the equity value of the business at the time that they're either put or called by the company. But there can be an opportunity here in terms of for companies to really drive future shareholder value by calling warrants in, because in situations where companies' equity values are increasing 10, 12, 15% a year, which can oftentimes happen, especially in the deleveraging year. If there's an opportunity for the company to go out and borrow money, borrow senior debt at a very favorable rate, and use that money to repurchase or retire warrants, over time, more of that future share appreciation is going to accrue to the ESOP and any other shareholders as opposed to the warrant holders. So, I tend to think of this as a little bit of just a different form of shareholder debt, albeit it is one that accelerates in value much more substantially and has a higher rate of return than just a normal course seller note. So certainly something that that management should be mindful of and the board should be mindful of as they're looking at how to drive future shareholder value for participants.
And as we go to this is one of my favorite slides because I love the visual that it actually gives. The key here, is you put the right plan design together for your business and hiring the right people to make sure you have the right plan to meet your desired outcomes, as well as to meet the future obligations that the company can support for its plan participants, which is really effectively employees. And so in the early years, plan design is important. As you get forward, the key is using the tax advantages of not having to pay any corporate taxes to deleverage fast. So if you kick that down as fast as you can, then all of a sudden you can take advantage of the tax benefits that you have as an entity to be able to get out and run like a thoroughbred, to be able to actually help your business grow into a level. The key, though, you have to be careful of is keep an eye on that repurchase obligation. As you can see here, the donkey's kind of got a little bit of an issue because he's kind of got a little too much weight that he's carrying, and that's the challenge. If a company gets too much weight on itself and is not able to support those obligations, then all of a sudden you need to really relook at the business, saying, how can we take some load off the business? So, and when some of the institutions look at it, they're looking at what is their repurchase obligation relative to EBITDA as a measure of where are we kind of getting out of whack, looking at the benefit levels, looking at the concentration of ownership. Some of those things are the things that you're really looking for when you're looking at the repurchase obligation. There's a lot of firms that will either, the board will do it, the board may retain other advisors to really kind of look at this repurchase obligation, whether it be looking with a third-party administrator to look at their plans, what's going on within those plans, and then hiring somebody else maybe to look at that. If you go to the next slide, really kind of talks a little bit about risk tolerance, the balance between risk tolerance of what you need to do when you're looking at the repurchase obligation and you're looking at allocation of those capital, whether it be the repurchase obligation or returning it back to shareholders. What's the risk tolerance of the business and the management team and the board going forward? Keep an eye on your valuations just to make sure those valuations are relatively fair and to the fair market value. And then on the next slide, this kind of circles back to our company example, the company that did run into challenges. You can see what happened to their share price, 13-14. I do have, my understanding is that the company now, with it got their 2019 value, is going to actually have to put a new chart in place because they're no longer on this chart. With that, I'd like to thank you all for taking the time to listen to our story. We hope that you and all your families are safe in this troubling time. And if you have any questions, hopefully we can answer them later. Thank you.
Absolutely. Thank you all very much.
Thank you.